Hey guys, I'm the Investment Venturer, and welcome back to the Investor Next Door podcast. Today we'll be talking about investing in the stock market. I should let you guys know that anything said on this podcast should be used for information and entertainment purposes only. This is not investment advice, and I do not recommend diving into any project or trying any strategy without doing your own research first. Let's start with, what is a stock? A stock is essentially owning a share of a company. To make it a bit more simple, think of the company as a pizza. A pizza, under normal circumstances, has many slices. When you purchase a slice of that pizza, that's like purchasing a share of that pizza. If the overall value of the pizza goes up, the value of your slice would also go up, and you can sell your slice of the pizza at a profit. The opposite is also true. When you purchase a stock, you may gain certain privileges such as voting or receiving dividends for the company. As the main goal of investing in stocks should be to gain positive returns, there are some things to consider before you start investing. Doing your own research. This is something you've either heard a lot or will be hearing a lot. This means conducting your own researching on the company's financial data, market trends, and other metrics which may affect the company's performance. Another important thing to pay attention to is news and industry trends of each company. By doing your own research, you can then make informed decisions on whether you'll want to invest in a specific stock. The benefits of doing your own research can be making decisions based on your research and not getting distracted by the advice of others and popular opinions. A downside can be that it is time-consuming to do detailed research on each company. Risk tolerance. Stocks are considered higher-risk investments compared to bonds. Be sure to invest what you can afford to lose. Diversification. A popular saying is, don't keep all your eggs in one basket. Diversifying your portfolio can make your investments less risky. This doesn't mean buying different companies within the same industry. It means diversifying into different industries like technology, for example, Amazon, Microsoft, and Apple. Transportation, for example, FedEx, Ryder Systems, and Air Canada. Consumer goods, for example, Coca-Cola, Nike, and Colgate. Stocks can be bought on major exchanges such as the New York Stock Exchange, NYSE, NASDAQ or Toronto Stock Exchange, TSX. Buyers and sellers come together to trade shares of companies that trade publicly. The price of each stock is determined by supply and demand. Supply refers to the amount of goods or services that producers are willing and able to offer for sale at a given price and time, while demand refers to the quantity of goods or services that consumers are willing and able to buy at a given price and time. So if there are more sellers than buyers, the price will go down. If there are more buyers than sellers, the price will go up. Let's talk about some of the different types of investing strategies that are most common. Income investing. People who do this typically look for companies with strong dividend growth and long history of dividend payments. Value investing. These people tend to look for undervalued companies that are trading at a discount. Growth investing. Growth investing means investing for capital appreciation, that is, the rise in an investment's principal value. Typically, growth investing in the financial world refers to growth at an accelerated pace, and most of us think of stocks when we think of growth. Passive index investing. Passive indexing is an investment strategy where the investor mirrors a particular market index. For example, you can match the elite 30 stocks of the Dow Jones Industrial Average, the broader stock market barometer of the S&P 500, or the tech-heavy NASDAQ Composite. Pick an appropriate fund or exchange-traded fund, ETF, that does the hard work on your behalf, and let it ride for years. Investors tend to use two additional strategies to add money to their portfolio: dollar cost averaging, DCA, and lump sum investing. Each have their unique characteristics and, of course, appeal to everyone differently. Dollar cost averaging. Simply put, dollar cost averaging is the practice of investing a fixed amount of money at regular intervals, regardless of current market conditions. Lump sum investing is the opposite of DCA. A lump sum investment is when you invest a large amount of money in a single transaction, as opposed to investing smaller amounts over time. Let's dive a bit deeper into income investing or investing in dividend stocks. Evaluating dividend stocks requires understanding several crucial financial metrics that help assess both reliability and potential returns. Let's explore these key ratios and what they reveal about dividend-paying companies, along with practical guidance for investors looking to build dividend-focused portfolios. The dividend yield stands as a fundamental metric showing the relationship between annual dividend payments and stock price. It's calculated by dividing annual dividends per share by the share price. While a higher yield might seem attractive at first glance, it's essential to look beyond just this number. Some investors make the mistake of focusing solely on dividend yields while ignoring stock price movements, which can be short-sighted since stock prices reflect overall company performance and market sentiment. When a stock's value increases, growing demand often follows, leading to higher prices, which can actually result in lower dividend yields due to the calculation method. When examining dividend stocks, the payout ratio becomes particularly important. This metric reveals how much of a company's earnings are being distributed as dividends, calculated by dividing annual dividends per share by earnings per share, EPS. A payout ratio between 10% and 30% suggests the company is maintaining a healthy balance between rewarding shareholders and reinvesting in growth. However, when payout ratios climb too high, 55% to 75% or higher, it might signal unsustainability and potential future dividend cuts. Companies must strike a delicate balance between attractive dividend payments and maintaining sufficient capital for operations and growth. The dividend growth rate serves as another critical indicator, showing how consistently a company increases its dividend payments over time. Companies with steady dividend growth often demonstrate strong financial health and operational stability, making them attractive to long-term investors seeking reliable income streams. Several well-established companies are known for their dividend payments. In the United States, notable examples include Altria Group, MO, JP Morgan Chase, JPM, Lockheed Martin, LMT, and Verizon Communications, VZ. Canadian investors might consider companies like Fortis FTS, Enbridge ENB, and Canadian Natural Resources CNQ. Each of these companies has established a track record of dividend payments, though past performance doesn't guarantee future results. For those interested in buying dividend stocks, the process involves several key steps. First, decide whether to invest independently or seek professional guidance. Then, select a suitable broker or robo-advisor. U.S. investors have options like Robinhood, SoFi, and Fidelity, while Canadian investors can choose from platforms like Wealthsimple, Questrade, or traditional banks. Each platform offers different features, fee structures, and user experiences worth comparing. The type of investment account is another crucial consideration. In the U.S., tax-advantaged accounts like 401ks and Roth IRAs offer specific benefits for retirement savings. Canadian investors have similar options with TFSAs and RRSPs. Understanding the differences between investing in individual stocks versus funds is essential before setting a budget and developing a long-term investment strategy. These account choices can significantly impact the after-tax returns of your dividend investments. For beginners, the stock selection process can seem daunting given the thousands of options available on major exchanges. However, legendary investor Warren Buffett suggests that most Americans would be best served by investing in a low-cost S&P 500 ETF. This index, comprising approximately 500 of the top stocks in the U.S. market, largest U.S. public companies, has historically delivered average annual returns of around 10% over the past 50 years, making it a reliable foundation for many investment portfolios. While complex investment strategies exist, many successful investors have built wealth by sticking to basic principles, using funds for the majority of their portfolio, and selecting individual stocks only when they have strong conviction in a company's long-term growth potential. This balanced approach combines the stability of diversified index investing with the potential upside of carefully chosen individual stocks. Remember that successful dividend investing requires ongoing portfolio management, and regular review of your investments to ensure they continue meeting your financial goals and risk tolerance levels. Focus on building a diversified portfolio that aligns with your long-term investment objectives rather than chasing the highest yields or following short-term market trends. Thank you for listening to my podcast. Be sure to subscribe to the Investor Next Door podcast on your favorite podcast listener. If you're watching on YouTube, be sure to like and subscribe for future episodes. Follow me on social media to stay updated. Twitter X @investNDpod. Instagram @investNDpod. Share this episode with your friends if you've learned something valuable from this podcast, and I'll see you guys next time.